After watching this video, you will have an extremely clear understanding of how to identify liquidity, how to use it, and what the different forms are, including a full trade breakdown of my entire trading strategy explained from A to Z that made me funded with over $1 million and has made me over $100,000 in prop firm payouts in the last 6 months. My name is Fabio, and for the past 5 years, I have been recording a daily market outlook every single Monday to Friday on the Forex market, explaining my view and perspective on the major dollar pairs, including gold. Now, this has provided me with a comprehensive understanding of exactly how to identify liquidity and how to get those sniper entries, using that in combination with supply and demand, market structure, and the premium versus discount tool. Now, if you want to learn more and understand exactly how to take these kind of entries, make sure to watch this entire video from start to finish. Let's dive straight in. Now, before we dive into the actual practice of taking trades when using liquidity, I'm going to show you the theoretical examples of the 3 main forms of how I personally identify liquidity on a daily basis. Now, the very first form of liquidity might seem very familiar to you, and this is very simply said where we look for a swing high or we look for a swing low. Now, what we believe is that above a swing high, that is where liquidity lies. And once that overall swing high gets taken out, what you want to be looking for is a market structure shift, or for example, manipulation, as you can see in this red box, in towards the downside, which confirms that the market is then ready to continue its overall leg further down. Now, the overall target will then always be the initial impulse, or the origin of the overall impulse, which took out the overall swing high. Now, for a long position, what you then have again is the overall swing low. We wait for the swing low to get taken out. We wait for the manipulation or the market structure shift to take place. We then believe that an area of demand will be formed, and then from that area of demand, we then wait to take a long position further in towards the highs. Now, let's dive into the second form of liquidity, also known as range liquidity. Now, when it comes to range liquidity, again, this might seem very familiar, where you have an area of consolidation of sideways price movement. All you're simply going to be looking for are equal highs and equal lows. Now, what we believe is that underneath the equal lows, that is where liquidity lies to look for a long position, and above the equal highs, that is where liquidity lies to look for a short position. Again, very simply said, you're just simply looking for manipulation above the overall swing highs, and most often you'll just want to wait for a market structure shift to take place to then take a short position, at least back into the 0.5 fib, which is also known as the mid-range of the overall area of liquidity. Now, actual practical examples of this will be shown on the chart shortly. Now, the third and final form of liquidity is also known as trendline liquidity, where we believe that underneath a trendline, that is where liquidity lies. Now, simply said, what you want to be doing is waiting for the overall trendline break to take place, and then you want to be looking for a short when the market was trending in towards the highs. Now, most commonly, this will work very well once you have a so-called 1, 2, 3, which is also known as a matured ascending channel. And what you simply want to be looking for is the first high, the second high, and then the third high, after which we believe that the overall drive in towards the downside will then take place. Again, the main reason and the main theory behind the overall drop in towards the downside stems from the idea that traders who went long on the overall uptrend or on the trend line have been placing their stop loss underneath the previous low. So for example, if you were to go long here on the second trend line tap, they believe that the overall stop losses are then placed underneath that first low. So therefore, we always believe that the market at some point in time will drive down lower to stop hunt those so-called stop losses, which are placed underneath those higher lows. Now, again, when we look at the overall downtrend, we believe that the stops are being trailed above the significant highs. So at some point in time, and most often than not around that third trendline touch, the market will then explode further in towards the highs to take out those stops which were trailed alongside those lower highs. Now, again, this doesn't necessarily need to happen on the third trendline touch. It's also perfectly fine that the market just continues to trend down lower. But at some point in time when the market structure shift takes place, we believe that there will be somewhat of an explosive move in towards the upside. Now, these are the 3 different forms of liquidity. Let's dive onto the chart and identify a beautiful trade example using it. Alright, so we're here on GPUSD, and straight away I can identify very, very easy and simple forms of trendline liquidity. So for example, here we have a first tap, here we have a second tap, and then here on the third tap, the overall market dumps in towards the downside, taking out the overall higher lows where stops are placed. And what you will most often see is that once you, for example, take out a significant low, such as these 2 second trendline taps over here, the market will provide you with somewhat of an aggressive reaction to the market or to that specific price point. Then again here on the initial low, which was formed over here, you can again see that that is where the overall reversal then in towards the highs take place. Now the second form of liquidity, which again is very easy to identify, is the so-called swing high liquidity. Now here we have, for example, a very clear swing high. How do I know that this is a swing high? Well, we see a very aggressive V-shaped reversal back in towards the downside. Now once the market comes above that overall high, that is where the overall reversal then in towards the downside takes place, which eventually takes out that overall ascending trend line. So this just shows how well these different forms of liquidity eventually can work together. Now when it comes to the actual trade breakdown, what I want to show you guys today is based on swing high liquidity. So first of all, what we have here is a overall swing high, and again above this swing high, that is where liquidity lies. So once that overall high gets taken out, straight away I'm in a short mode. I believe that there is potential for the market after taking out that high to drop in towards the downside. Now the second form of liquidity straight away that I can identify here is trendline liquidity, because what do we have here on the weekly time frame? We have the first tap taking place here and the second tap placing over here. So I believe that underneath these lows, that is where liquidity lies, which I eventually want to see get taken out. Now for the actual entry to take place, I drop down to the daily, and again that overall weekly trend line becomes a lot more clear. Now what I want you to remember here is the overall ascending channel, which I mentioned from the overall trendline liquidity phase, where we have here a one high, second high, and then a third high taking place in towards that blue dotted line, which is the weekly liquidity high, and which corresponds with the overall fact that we have the 1-2, and we're now looking for the overall sell-off in towards the downside to take out these two initial lows. Now the easiest way to identify that the actual market wants to head down lower is by looking for a so-called change of character that took place after taking out the overall swing high. Now I myself use an indicator called the fractal structure break indicator. If you want access to this indicator, make sure to check out the link in the description down below. And what we simply said have over here is a drive up, a pull back down, a drive up, and then the market structure shift in towards the downside, breaking this black line, meaning that the market is now bearish in between the fractal high and the fractal low. Now here we have bearish market structure. Second of all, we took out the blue dotted line, which was liquidity. And third of all, what do we have here? We have a beautiful area of supply on the buy up for the sell down, breaking market structure. Furthermore, we're going to look to go short from premium pricing, which is above the 0.5 fib. So therefore, you can now place an entry here on top of the daily time frame with the stop loss above the high, targeting, let's say, the overall first liquidity low, which is positioned over here. Now, if you want to further refine your entry, you can obviously drop down in towards the 4-hour time frame or even the 1-hour time frame. So what we see happening here is that the market reverses in towards that area of daily supply. Now, after tapping into that daily area of supply, what happens? We get the initial change of character again. Push up, pull down, push up, push down. And now we're looking again at this area of supply that is now being created, from where, for example, on the 4-hour time frame, you could go short. Now, keep in mind, there is still an area of supply open, for example, over here. So I would place my stop loss a little bit wider. There's no need to really be it or place it so tight. And then again, we target that overall second liquidity low. Now, what we see happening is that the market comes back up in towards that area of supply. It starts to consolidate a bit, but then the overall momentum continues in towards the downside. Now, from this point onwards, all you're simply going to be doing is following the overall order flow, also known as the overall buy before the sells. Now, what we have here is a buy for a strong sell down, breaking market structure. So again, I expect the market to continue pushing down lower from out that overall buy before the sell. Now, what we can do again here is drop up to the daily time frame and quickly check, is everything still in correspondence? Yes, everything is still looking good. We have a second daily fractal break, again, according to our indicator. So short still makes sense. As long as the current fractal high is still respected, we still remain bearish. Now, going back to the 4-hour time frame, we can then see that the market interacts with that area of supply and then once again sells off in towards the downside. Now, at this point in time, here again, we have another buy before the sell that is now in control. And as long as this overall order flow maintains itself, and with order flow, I'm just simply referring to the push down, buy up, push down, buy up, push down, buy up, push down, then another buy up would be perfectly fine to then again look for another short position. You can see that the market just continues with a lot of momentum, and eventually we hit our TP here, which corresponds with the overall liquidity low. Now you can see here that this actually also corresponds with the fact that this is just a swing low, right? We can see here very clearly that this is an overall low from where a V-shaped reversal in towards the highs take place. Now this means that you could potentially look for a reversal trade back in towards the highs, in towards this area of daily supply. Now looking here, we can see, okay, daily time frame has taken liquidity. Now I drop down to the 4-hour time frame. After grabbing that daily area of liquidity, I can see here that the 4-hour time frame provided me with a market structure break in towards the highs, meaning that this overall sell for the buy up that broke market structure here is my area of demand from where I want to go long. So let's say we place here another long position, again with our stop loss underneath the overall lows, targeting that overall daily supply zone before then again looking for a short position. What you then see happening is that the market continues up higher, back up in towards that supply zone, and then from there eventually we head back down lower for another TP hit. This is how to trade with liquidity. Hope you guys enjoyed this video. If you have any questions, let me know in the comment section down below. See you in the next one.